Let's talk about REITs, real estate investment trusts. For years, you've probably heard they're an absolute must-have for any serious portfolio, a key to diversification, a source of income. But what if that's all wrong? Today, we're going to dig into a pretty provocative take on one of investing's most accepted ideas. And there you have it, right from our source material. A big nothing burger. Now, that doesn't mean they're necessarily bad. It just means they might not be all that special. And, in investing, if something isn't special, you've got to ask yourself why it deserves a dedicated spot in your lineup. So, if they're not special, why does almost everyone recommend them? That's the big question we're tackling today. We're going to dive into the 3 biggest arguments people make for owning REITs and see if they actually hold up. Think of us as your myth-busting team for this one. Okay, let's kick things off with myth number 1, the real estate myth. This is the big one, right? The most obvious reason to buy a REIT is, well, it's right in the name. You want a piece of the real estate market. But are you getting what you think you are? This is where things get a little weird. You see, a REIT isn't defined by its business, but by its tax structure. It's a legal classification. So you might end up owning a company that just manages cell phone towers, which feels a lot more like a tech infrastructure play. Meanwhile, a classic home builder, a company that actually builds houses, a lot of times that's not a REIT at all. It really makes you wonder, if you want direct property exposure, are REITs even the best way to get it? And here's the kicker, especially for all you index fund investors out there. If you own a broad fund like the total stock market, guess what? You already own REITs. They're in there, weighted just like every other public company. So the real debate isn't about owning REITs versus not owning them. It's about whether you should go out of your way to overweight them and give them a special, bigger slice of your portfolio pie. All right, moving on to the second huge claim, the diversification myth. You've heard this a million times. REITs are great because they zag when the rest of your stocks zig. They smooth out the ride. It's a great story for sure, but let's see what the data actually says. So, this is the classic textbook argument. The term is low beta. All that really means is they're not supposed to be as sensitive to the stock market's big swings. In theory, that makes your whole portfolio less volatile, which sounds pretty good to all of us. It's why they get recommended so often. But what if REITs aren't some unique magical asset class? Here's where it gets fascinating. One academic paper basically reverse-engineered REITs and found you can pretty much replicate their performance with a simple recipe. About 2/3 small-cap value stocks and 1/3 corporate bonds. So maybe their special zag isn't so special after all. Maybe it's just the behavior of smaller value-type companies. And that leads us to a really practical question. If all we want is to add some stocks that don't move in lockstep with the rest of the market, are REITs truly the best tool for that job? Or are there other options that might do it even better? Okay, let's put it to the test. Time for a little showdown. We're going to take the big Vanguard REIT ETF, ticker VNQ, and put it head-to-head with 2 other classic low-beta sectors, utilities using the VPU ETF, and consumer staples with the VDC ETF. And boom, here's the first big problem for the diversification argument. This chart shows us correlation, how closely these things move with the S&P 500. A score of 1 is perfect lockstep. You want a low number for diversification. REITs, or VNQ, clock in at 0.74. Not bad, but look at utilities, VPU, just 0.54. I mean, the data is pretty clear here. Utilities have been a much, much better diversifier than REITs. Okay, so maybe REITs don't diversify as well, but maybe they deliver better returns to make up for it? Nope, not according to this. Over the long haul, both utilities and consumer staples delivered higher returns, while REITs trailed behind. And here is the final piece of the puzzle, risk. This chart shows volatility, basically how bumpy of a ride it was. And wow, REITs were dramatically more volatile than the others. So let's recap the story so far. Lower returns, higher volatility, and worse diversification. That is not a great look. But looking at these assets one by one is one thing. The real asset test is what happens when you actually combine them in a portfolio. So let's see how this all shakes out in the real world. Okay, this table right here, this is the smoking gun. It shows a test of a few different portfolios, and the only thing that changed was one 20% slice. And the portfolio with REITs in it came in dead last on almost every single important metric. It had the worst crash, that's the max drawdown, and the lowest Sharpe ratio, which is just a fancy way of saying you got the worst return for the amount of risk you took. The portfolio with utilities, by the way, it was the best on that risk-adjusted basis. All right, but there's one last argument we have to tackle. The dividends. Come on, REITs are famous for their high dividend yields. It's a huge draw for income investors. But there's a catch, and it's a big one that lives in the tax code. This is so important, but it gets overlooked all the time. Dividends from REITs are usually ordinary, which means they get taxed at the same high rate as your regular paycheck. But dividends from most other stocks, like from that utilities fund, are often qualified. That means they get a special, much lower tax rate. The difference in your take-home pay can be massive. So here's the bottom line. Even if that REIT fund boasts a slightly higher yield on paper, that advantage can get completely wiped out once the tax man takes his bigger slice. If you're investing in a regular taxable account, you could very well end up with less cash in your pocket from the higher-yielding REIT. So we've kind of dismantled these long-held beliefs. What does that mean for you? Where do we go from here? Let's talk about some smarter alternatives based on the actual evidence we've just walked through. It really comes down to what your goal is. If you truly want that zag, that low correlation to the market, the data suggests utilities are a better bet. If your main goal is just to make your portfolio less bumpy, consumer staples have done a better job historically. And hey, if you just like the return profile of REITs, well, you can get something very similar from a small cap value fund, probably with better results over the long run. This quote really just nails it, doesn't it? The whole argument isn't that REITs are terrible investments, it's that we assume they have these unique superpowers that when you look closely at the evidence, either aren't there or can be found more easily somewhere else. And that leads us to the final conclusion. When you look at the evidence on their performance, their diversification, and how they're taxed, the argument is pretty simple. For most of us, there just isn't a compelling reason to go out of our way and carve out special room for a dedicated REIT fund. And that really leaves us with one final big question to think about, a question you should ask about every single thing you own. Is its spot in your portfolio justified by myths and things you've just always heard, or is it truly backed up by cold, hard evidence?